We're going to wrap up the accounting cycle with a preview of the closing process. We are now at the end of the accounting cycle. We've gone through the analysis and recording of transactions during the period. We've made adjusting entries and prepared an adjusted pre-closing trial balance. Now we're ready to close the books. And we do this through closing entries. These are made for two main purposes. First, they serve to reset the temporary account balances back to zero. And what are temporary accounts again? These include revenues and expenses, gains and losses, and dividends. In other words, any account that shows up on the income statement, they're going to be reset to zero, while the balance sheet presents the running totals of all the permanent accounts from one period to the next. The income statement is designed to summarize a company's performance for one single period. We take all the relevant income statement accounts, those revenues, expenses, gains, and losses, and close them out so they can start the next fiscal year from fresh. And the other type of temporary account to remember is dividends. These are not reported on the income statement, but as a temporary account, they reflect one-time distributions of cash to the company's equity holders. Okay, second, closing entries transfer those balances over to retained earnings, which is a permanent account. Recall that for now, we've considered shareholder equity to include paid-in capital plus retained earnings. To some extent, retained earnings reflects the cumulative profitability of the company, the running total of profits and losses that owners have allowed to be retained in the company as opposed to being distributed via dividends. Okay, so a quick important reminder. Net income in and of itself is not an account. It's just a calculated figure on the income statement. So when we close, we are moving the individual revenue and expense balances into retained earnings. And the net effect of that is as if we had added net income to retained earnings. So one more time on the why behind all of this. The reason why we go through this exercise every fiscal year is simple. We want each year's income statement to show only that year's performance, not a running total of every dollar the company has ever earned or spent. Let's take a look at what closing entries look like in practice. And there are a variety of ways we could represent this. The first entry handles the income increasing accounts, like revenues and gains. You debit each of them for their balance. In other words, the opposite of their normal balance. We do this to zero them out. You then credit retained earnings for the total. Specifically in this entry, we're taking sales revenue, interest income, and a gain from a sale, and debit these accounts. Retained earnings then gets credited for the total. The next entry handles expenses and losses. You debit retained earnings for the total, and you credit each expense and loss account, which again zeroes them out. So cost of goods sold, depreciation expense, losses on investments, all credited away to zero. This last entry handles dividends. We debit retained earnings and credit the dividends account. After all three entries post, the temporary accounts are at zero, and retained earnings reflects net income minus dividends for the period. We could also combine all of these closing entries into one singular journal entry, debiting all income increasing accounts, crediting all expenses and dividends, and then looking at this, will retained earnings be debited or credited? Well, in a combined entry, it depends on what the numbers are, on the relative amounts of the revenues and gains versus expenses, losses, and dividends. If our income increasing accounts are greater than our income decreasing ones, retained earnings will get the credit for the difference. Whereas if our expenses and losses and dividends, if those were greater than our income increasing accounts, retained earnings would be debited. All right, well that's it then. With adjusting entries and the closing process in your toolkit, you now have the full back half of the accounting cycle.